I've been asked in my 15 minutes to look at tax, confidence in the system, governance, growth, as well as the role in the economy in terms of the capital pool. But let's start with some big figures. The system, the universal system, started in 1991. Choice, which was a real game changer because that's when decision on both investments and fund was handed over to the community, started in 2005. Yes, it's around 1.8 trillion today, but by 2037, we're about 6 trillion. It contributes about 1.5 to GDP. By 2026, and David made this point, there will be 42% of people in drawdown, and we don't have the arrangements in place for that. When you look at where the pool is at the moment, a third is in default, a third is in choice in terms of people have chosen their own portfolio, and a third is in drawdown. At the moment, it saves the government about $7 billion in the age pension, and that's set to go to $55 billion, which is one of the key roles of the system. So let's look at the roles of the system. The first thing, and this is what it was designed to do, is improve retirement outcomes. And again, it's not about wealth accumulation, it's about adding to people's income in retirement. Its second objective was to reduce reliance on the age pension and reduce the ongoing cost of the age pension to the government. The third was to improve national savings. Now it's starting to meet, and it's met most of those in various ways. At the moment, the system is on track to deliver to the average Australian 75% of their pre-retirement income. But let's look at another couple of figures. Let's look at the reliance on the age pension. So what you can see by this graph, and it's really the full age pension figures that will give you the best idea. You can see that reliance on the age pension is substantially decreasing. It's decreased over the last 13 years, and it's going to decrease another significant amount in the next 13 years. So in the next 13 years, the reliance on the full age pension by 65-year-olds is going to reduce from 44% to 25%, and that's where that $55 billion in savings comes from. The other important figure to look at is the amount of people that are self-funding. So this is where they're not reliant on the full or the part age pension, and this is based on the rules around the pension today. And again, there is significant growth from 22 to 40% of people in retirement who are fully self-funded post-65, and that takes into account longevity. So that's a significant change, and I think a significant reflection on how well the system is doing at this time. Doesn't mean it needs to change, but it's certainly at this time, it's not a disaster. Another way to look at it is, again, the way in which the superannuation system provides additional amounts or income in retirement. Now remember, was it meant to fully replace the age pension? No, it was meant as a top-up for the average Australian. So when you look at today and you look at in the future, you can see that the reliance for income, and again, pensioners and people in retirement, on average, they do not get a great deal of money. But the proportion of income where they are not relying on the age pension is increasing. So by 2026, an average person, using again today's dollar, will be receiving about $14,500 from the age pension, but nearly $20,000 from their superannuation. When people have a higher income in their retirement, you'll have more when it comes to dignity, but also contributing to the to consumer in the Australian economy. Of course, you can't talk about super if you don't cover tax. And I think there's two parts of tax that you've got to look at. The first is how much, and the second is who pays. So the figure that's often mentioned is $30 billion, and the figure of $30 billion is mentioned in Treasury forward estimates, but there are many caveats around it which are often ignored. We estimate that the true cost of tax concessions into the system today are around $16 billion. And that's because the $30 billion does not take into account the fact if you change the tax concessions on the super system, particularly for the more wealthy income earners, that doesn't take into account the change in behaviour. You reduce the tax concessions on super, many of these people will move into other savings that does receive tax incentives, such as domestic property and negative gearing. So that means that the cost to the government in terms of tax concession would not reduce as much. There'll also be lower savings in superannuation, which would also decrease the tax revenue to the government. The $30 billion figure also does not take into account the savings on the government age pension, which, as I said, is $7 billion today. So we have to agree on what is the real cost. And then the second question is where. And it's very important that the tax concessions are equitable. Now, on one view, if you take into account the cost of the age pension and who will be reliant on the age pension, many people, including Treasury, believe it is fairly equitable. But a lot of that is really dependent on ensuring that the low-income superannuation contribution scheme or the LISC scheme continues. It does give that real boost to lower income earnings. But let's look at where those tax concessions really are. In terms of contributions, you'll see that the tax concessions, over half goes to people on under $100,000. Where you start to get the real inequity is in terms of the investment earnings. Now, understandably, the tax concessions on investment earnings primarily go to very high account balances, which are usually very high income earners because of the higher tax balance, because of the higher investment balance. And that is where I think some of the tweaking can be done. And that is in terms of going back to the role of the system. It is about providing incomes in retirement. We have accounts at the moment that have millions and millions of dollars in them. These are individual accounts. One account, there's over $60 million in the account. That is not about retirement income, that is about wealth accumulation. These are previous rules that did allow extra monies and business assets to be transferred into superannuation. It's time to look at that and see how we can, in a simple way, get that money back. In terms of retirement, again, most of the tax concessions do go to people under $80,000 income. So it's something we have to watch, particularly as people are retiring on higher account balances. We know that there are some issues with transition to retirement, but it is a conversation we need to have, and it will come out as part of the government's tax white paper. So let's look at confidence in the system and governance. And you start off with, well, who is actually looking after the money? Now, as we can see, there has been a significant change in people managing their own money, and this is the self-managed fund sector. Around 34% of the money is in that sector. That may grow to 50%. The average account balance of a self-managed fund is $490,000. The average account balance for a pooled vehicle is $51,000. For industry funds, it's even lower, it's under $30,000. But over 95% of people are in pooled vehicles, under 5 are in self-managed funds. So how the governance work, how the regulation work, has to reflect that. We know that over half of the money today is in income streams. Again, and a lot of that is in self-managed funds. The governance around that in terms of the system is vital. David talked about systemic risk. One of the issues we have in our system is that we've got two major pools, a pooled system, self-managed fund. There's no regulator at this time charged with looking at systemic risk across the whole pool. It's just related to the superannuation pooled vehicles at this time. So as we change our governance, as we look at the change in nature of the vehicles and who is managing the money, we look at some of the consumer protection gaps which are starting to happen. There's monies that are invested in super that are not part of the Corporations Act and not part of financial services reform. Many people that are investing in super are not receiving financial advice, and they don't need to. And these are issues I think we can change in terms of governance. In my last slide, I think it's important again as we talk about the role of the super pool in the economy, we need to look at where the money is. And again, how the money is invested depends on how much control individuals have and how much understanding there is around the duty of care of managing retirement money. Superannuation is about retirement incomes. It's about long-term investing. It's about, in retirement, producing income streams. Those basic tenets are often forgotten as we look at the role of the system and we look at the current regulation around the system. So as you'll note from the table, when it comes to pre-retirement assets, those in accumulation, half is in choice, so this is not only self-managed funds, but also in investment portfolios within funds. And that's more in retail funds where you have financial advisors, but certainly in the other sectors as well. Your MySuper is where the default is. Your MySuper, so when we talk about, and I hear it from many politicians, why can't the 1.6 or 1.8 be put into infrastructure? You've only got 500 billion that is actually controlled by the trustees in terms of that true fiduciary obligation. You can't put all of it into infrastructure. Currently, there's less than 10% in infrastructure. There's about 50% in equities, and that's the combination of international and Australian. Less than 20% is in fixed interest, again, local and international, and there's a bit less in property. But that is where the MySupers invest, and that again is about long-term investing. We do not have a MyPension, so that is invested for accumulation and lump sum only. As we move to investing for individual retirement goals, that's where the asset allocation will start to shift. When we go into retirement, again, this is where people do have a clear choice. One of the most difficult aspects today is that there isn't a real choice when it comes to retirement vehicles because of the limitation on the way our regulation is. There's very little ability to innovate in post-retirement products. The way deferred annuities are taxed, it means that you actually penalise for taking out a deferred annuity because you are taxed today as if you were receiving the income. There are ways in which we can change the comparability of funds where, rather than compare costs, you're actually compared on what type of income. If I retire with a lump sum of $100,000 today, what one fund will provide me in terms of income for the rest of my life compared to another fund. There is very little in terms of the ability to innovate in terms of longevity products, which are absolutely vital. We should be able to structure our system and our products and our funds so that you can actually start to invest in longevity risk earlier, not at age 65. But the system is designed from the time you start work to the time you retire. It's not designed as a whole-of-life system. And this is the challenge for us, and it's one of the things we hope to see coming out of the financial system inquiry. Thank you.